Half of all life insurance policies in America expire worthless. The owners paid premiums for 15, 20, sometimes 30 years. Then the policy ended. The family got nothing. The insurance company kept every dollar. This is not a scam. This is how the system is designed to work. And almost every person who buys life insurance walks into the same trap in the same order from the same agent and never realizes it. In the next 10 minutes, you will see exactly how it happens, the 2 types of policy that actually make sense for normal people, and the 4 things your agent will never volunteer. You probably have a number in your head right now, maybe 100,000, maybe $500,000. Some policy your employer set up, some policy a friend sold you in your 20s. You think your family is covered. Run the math. Your mortgage, maybe $240,000. Your kids' college, $80,000 each, minimum. Lost income for the next 10 years, $500,000 at the low end. Final expenses, funerals average over $9,000 in 2026. Debt, credit cards, car loans, medical bills. You are not looking at a $100,000 gap. You are looking at $1 million gap, and your current policy will cover roughly 15% of it. That is not a worst case. That is the median American household, and the only person who knows the math is the agent who sold you the wrong policy. The data here is not opinion. LIMRA, the largest insurance research body in the United States, tracks every category every year. 42% of Americans say they need more life insurance than they have. The average coverage gap is $200,000, and the FINRA studies show that 98% of term life policies never pay out a claim. Not because people lived, because the policy expired before the death. These numbers are not new. The industry knows them. They are why life insurance is sold the way it is. There are 5 common types of life insurance. You only need to understand 2. Term life and whole life. Everything else is a variation invented to sell you something more expensive. Term life is pure insurance. You pay a fixed premium for a fixed period, usually 10, 20, or 30 years. If you die during the term, your family gets the payout. If you don't, the policy ends and you get nothing back. A healthy 35-year-old can buy a $500,000 20-year term policy for around $30 a month. That's it. No tricks, no investment piece. Whole life is different. It lasts your entire life. The premium is much higher, often 10 to 15 times the cost of term. Part of your payment buys insurance. The other part goes into a cash value account that grows slowly. That same 35-year-old looking at a $500,000 whole life policy will pay around $400 a month for the rest of their life. Here is the part nobody tells you. The commission an agent earns on whole life is roughly 10 times the commission on term. Same client, same coverage need, 10 times the payout for the agent. That is why whole life gets sold so aggressively. If you have dependents, debt, or a mortgage, term life almost always wins. The 10 times your income rule you keep hearing is lazy advice. It comes from agents because it's easy to remember and almost always points you toward a bigger policy. Use a real calculation instead. Insurance professionals call it DIME. D, debt. Add up everything you owe: mortgage, credit cards, car loans, student debt, every dollar your family would have to keep paying. I, income. Multiply your annual income by the number of years your dependents would need support. For a spouse and young kids, that's usually 10 to 15 years. M, mortgage. List it separately because the number is large and people forget to include the full balance. E, education. $60,000 to $80,000 per child for college, minimum, in current prices. A typical 35-year-old with a partner, 2 kids, and a normal suburban mortgage will land between $750,000 and $1.2 million in actual need. Most people own $150,000. The gap is not a small mistake. It is the entire reason life insurance was invented in the first place, and the reason it fails to protect most families. Life insurance is one of the only products on Earth where the price goes up every single year you wait. A healthy 30-year-old buying a 20-year term policy pays around $25 a month. The same person, same health, buying the same policy at 40 pays around $55. At 50, it's over $150. This is not inflation. This is mortality risk. The older you get, the more likely you are to die during the term. The insurance company prices that in. Then health changes. Get diagnosed with high blood pressure between policies. Your rate goes up. Pre-diabetes, your rate goes up. Cancer history, you might not qualify at all. A normal 20-year-old can lock in a 30-year level term policy at $20 a month and ride it untouched until age 50. A 45-year-old with newly diagnosed cholesterol issues might not be able to buy any policy at any price. The no medical exam policies you see on commercials, they cost 3 to 5 times more and cap your coverage at $50,000. They are not a substitute for a real policy. They are a backup for people who waited too long. If you have dependents and you do not yet have term life, the right time was last year. The next best time is this week. 4 things. First, universal life and indexed universal life. The IUL. The agent will pitch this as permanent insurance that builds tax-free wealth. It is the most profitable product for the agent and one of the worst for you. The internal fees compound silently. Returns are capped. The cash value rarely outperforms a basic index fund after fees. Walk away. Second, your employer's group life policy. Most workplaces provide a one-time salary policy for free. Most people assume that's enough. It almost never is. And the moment you leave the job, the policy ends. If you only own group life, your family's protection is tied to your employment status. Buy a private term policy separately. Third, the replacement scam. Agents get paid a fresh commission every time you switch policies. So they call. They tell you rates are lower now. They convince you to cancel your existing term life and start a new one. You restart your contestability period. You lose the lower rate you locked in years ago. The agent gets paid twice. You get nothing extra. If your current term policy still works, leave it alone. Fourth, riders. The accidental death rider, the return of premium rider, the child rider. Every one of these increases your premium. Almost none of them deliver meaningful value. Agents push them because they bump the policy size and the commission. Skip them. Use a clean, simple, level term policy. Those 4 moves alone separate the people who use life insurance correctly from the people who get used by it. The buying process is simpler than the industry pretends. Decide your number using DIME. Land on a coverage amount and a term length, usually 20 or 30 years. Get quotes from at least 3 sources. Online platforms like Policy Genius, Quotacy, or SelectQuote pull instant quotes from multiple carriers. You can do it in 15 minutes without giving anyone your phone number. Pick the cheapest policy from a carrier with an A or A+ financial strength rating. The brand name does not matter. The financial rating does. Take the medical exam. It's a paramedic in your kitchen for 30 minutes. Blood, urine, height, weight. Be honest. Lies on the application give the insurance company a legal way to deny the claim later. Once approved, you pay your first premium and you're done. The whole process, start to coverage, takes 3 to 6 weeks. Half of all policies expire worthless. That was the opening. Now you understand why. It's not because people lived. It's because they bought the wrong type, in the wrong amount, at the wrong time, and never came back to fix it. You can stop being one of those families. Buy term. Run the DIME math. Lock the rate while you're young and healthy. Skip the rest. If you found this helpful, share it with someone who needs it. And subscribe for more.